Greetings, single point clients and friends. It's Rene coming to you to share some perspectives on the current state of the market sell-off. Let's just jump right in. You're seeing a graph that plots the value of the S&P 500 in purple. You see that as of about 10 minutes ago, we were approaching a 20% drop from the most recent high at the beginning of the year. The orange line tracks the aggregate bond index, which is an index of the safest bonds out there. That's down about half as much as the stock index. It's down about 10%. And really the story so far this year has been dominated by fears of inflation. Of course, inflation has been in the headlines for some time, probably going back about 7 or 8 months. But it really hasn't been until February and March of this year that the Fed finally came forward with a very clear, direct, and aggressive plan to try and slow the economy down to bring down the inflation rate. So obviously the market is currently reflecting and pricing in much higher borrowing costs and much higher interest rate levels, as has been signaled by the Fed. How much higher interest rates are reflected in this current drop in the market, the one that we're living through now. I would say that the market has priced in a 3% federal funds rate. So we started the year at basically zero. So the market's pricing in a move by the Fed from 0 to 3% by the end of the year. Obviously, the market has sold off in anticipation of those future rate hikes that have been penciled in and programmed for this summer. There's going to be probably 3 more half of a percentage point rate hikes occurring probably in June, July, and September. And thereafter, potentially tapering down to 1/4 of a point. But it'll be very dependent upon how the inflation statistics come in over the next 3 months. The market is hungry to see the inflation statistics begin to crest and begin to soften a bit from very high levels. And we're currently running at about an 8% headline inflation rate, at about 6% core inflation rate, which is the statistic that really the Fed focuses on because it strips out some of the more volatile food and fuel components. But nevertheless, that 6% core inflation rate is running about 3 times higher than the 2% target that the Fed has set out for itself. So the Fed's got some work to do. And the playbook is well understood, right? The Fed is trying to bring down inflation primarily by cooling things down in the economy. So the unemployment rate is at a 50-year low. The labor market is as tight as it has been in more than a generation. Obviously, that's creating a lot of wage inflation, and that's feeding into a lot of the other sectors of the economy as well, and showing up in the form of higher prices for consumers and households and businesses as well. The interesting thing that I just want to spend a couple of minutes on is that, the bond market has sold off precisely because bond prices reflect bonds that were issued in the past at much lower coupons and interest rates than what are available today for similar type of maturities and credit profiles. So obviously the bond market is already pricing in a much higher interest rate level, probably an interest rate level that the Fed has guided towards for the end of the year of around 3%. Interestingly, the stock market, on the other hand, is now selling off and reflecting fears of a recession, right? You don't get a 20% move in the stock market unless you believe that corporate earnings are going to actually decline, not just slow down its growth rate. So we're seeing a repricing here that reflects inflation fears in the stock market. Recession fears in the stock market and inflation fears in the bond market. Those two conditions can't coexist, for too long a period. I think over the next few months, I think we're going to find out what is really the big risk to the markets. Is it inflation or is it recession? But you can't have both, right? Because by definition, recession implies creating the conditions for there to be layoffs, for there to be significant slack in the labor markets, which is inconsistent with the idea of hot and rising wage inflation. So with that said, I want to, again, put this in the appropriate historical perspective. As you guys know, I'm a bit of a historian here, and just want to go back a few years, want to go back 3 years, and just revisit. Actually, let me go back 5 years. I want to revisit a couple of episodes that have some similarities with what we're living through now. Obviously, this is a big move down, 20% move down here. By the way, on a 5-year basis, the market's still up 61%, right? So obviously, this recent sell-off comes on the heels of a torrid rally that really took the market up to a very high level as of the end of last year. But nevertheless, it's always painful to have to see those kinds of extreme moves down. Though I will say that the move that we saw in the spring of 2020, right, when the COVID lockdowns were announced, that was a move down of approximately 30%. And let me show you a different view. This is a chart that shows the percentage drop off the recent highs. So here we are, we're about 20% off the recent high. And you compare that to the pandemic drop, that was a 34% drop off the recent high at the time, at the end of 2020, at the end of 19, I'm sorry. And then if you go back just a couple of years before that, and a lot of folks actually have forgotten this, at the end of 2018, there was actually a 20% drop in the market. You may recall at the time, the trade war with China was raging, and there was a lot of pressure on the Chinese currency and fears that China might get tipped into a major recession as a result of the Trump tariffs, right? So that led to a big sell-off, 20%. It was a very quick rebound, right? By April, May of 19, we had basically recovered all the lost ground. And similar during the pandemic collapse, right, which was much bigger in magnitude than the 2018, and so far what we've seen here in 2022. Okay, so looking at these charts, of course, the question in everybody's mind is, are we close to the end here? And it's always impossible to predict the bottom of the market. I can tell you that market sentiment is very negative. Everything is being sold, not just the high-flying tech names, which of course were the ones that had gotten bid up the highest during the bull market, but now everything is getting sold off. Whether it's the bank stocks, the retailer stocks, the tech stocks, the consumer staple stocks, the energy stocks are holding in a little bit better because of the price of energy, but even there you've seen a little bit of downside pressure. So, tough to say when the bottom will be found. Things could get worse before they get better, and that will depend upon how the inflation statistics come in the next few months. But I will say this, that looking at this downward move in the equity market, in some ways, for a long-term investor that is thinking about the next 10 years, not the next 10 months, right? I view this as an excellent buying opportunity and as a good entry point for folks that are sitting on a lot of cash. And I would I would also say that to the extent that we do get another leg down, and it's not completely out of the picture that we would see, this 20% drop become a 30% drop, right, over the next couple of months. And if that were the case, I think everybody here knows our playbook. I think we have a discipline around staying true to our long-term stock to bond targets, and a move of that magnitude would likely result in us rebalancing portfolios back to target, which means leaning a little bit into the weakness and buying into that equity sell-off, assuming that we do get another leg down on top of the 20%, right? And using the bond buffers that we have in client portfolios or cash buffers, right, to get to move that stock and bond mix up to its target. So again, 11 minutes. Hopefully this is not too long-winded. We've been here before. We know the playbook. And obviously for long-term investors, this is obviously not fun, but it's also an opportunity. I hope this is helpful, and if you have any questions, you guys know where to reach me. Thank you.